with that. 1.5 minutes to go for the market opening. Should be good. 40 points up on the pre-opening today. Vetri Subramaniam of Religare Mutual Fund has joined in. Vetri, good morning. Are the signs looking ominous to you, the way the prices have been moving the last few sessions?
Not a question of ominous, then I think it just reflects the reality that we are facing fairly challenging economic circumstances at this point of time, and the outlook for earnings growth is extremely muted. It's not clear at which point of time the economy will be able to gain some momentum. Things have been happening on the policy front, but it hasn't yet really translated into action on the ground in terms of an improvement in growth. So I think these are the challenges the market faces, and even the one support that one could have looked forward to, which is significant monetary policy support, is going to be a little difficult to come by, because even though growth has tapered off, inflation remains fairly resilient, and I think the central bank therefore is likely to cut rates only if the data is supportive in terms of further rate cuts. So really, the markets are reflecting a challenging environment, and that's about it.
Stay on, Vetri. We'll have many more questions for you. Right now, let's focus on the market opening. Should be a positive one, led by stocks like ITC and Infosys, which have corrected quite a bit these last few days. Here are the first rates on the Nifty. 5535. That's up 38 points like this. Aside of the breadth, which looks good optically, 460 to 160, there's not too much energy in the market, particularly in the larger caps names. Vetri Subramaniam of Religare has been speaking to us, so let's get right back to him. Vetri, the problem for the last few days has been that foreign flows seem to be deserting us. Do you think that's out of disappointment that growth is taking so long to recover, or is it just a relative game where other markets are looking more attractive?
I suspect it's a combination of everything that you mentioned, Udyan, and also, keep in mind that we actually got a fairly large sum of money during the previous 12 months. In fact, it's so large that a lot of the regional strategists we've been talking to are still a little bit surprised by the data indicating such, robust flows into India. So, trying to predict flows is always a very hazardous thing, and, I'm a bit wary of trying to do that. The reasons why the money may have stopped coming in or they're going elsewhere, it could be a variety of things. It could be a little bit of disappointment that 6 months after the new finance minister took over and there was optimism that things would start to turn around quite rapidly, there is really no sign. It's not that the government has not done things. To be fair to them, I think they've tried to do a fair bit on the policy front as well as in terms of administrative decision making, but this is a giant size super tanker, and turning it around is not an easy proposition. So I think we're dealing with that battle, and parallelly investors are clearly seeing momentum in other markets, and let's not forget that a lot of portfolio flows are always momentum chasing. So if you start to see momentum in some other markets, I'm quite sure that it's the natural tendency of money to flow towards those markets.
Vetri, hi, good morning. The problem though is that that's the only leg the market's been standing on these last couple of months. So one wonders what happens if flows or outflows exacerbate, and whether the market then becomes more vulnerable on the downside.
Yeah, I think the market is vulnerable, but not for the reason you mentioned, Mithali. I think the vulnerability is literally the fact that, growth prospects are still very, very muted. I think we're likely to have the corporate earnings season for the quarter ended March show that Indian companies' revenues grew at single-digit levels of about 6 or 7%. This is a dramatic slowdown that we are seeing. So I think the vulnerability is economic. It's not just to do with the flows. But having said that, I would also add that, valuations in that sense are not really, a big risk to the market at this point of time. We've been looking only at trailing earnings now for the last 2 or 3 years because we found the forward estimates a little hard to digest. And on trailing estimates, the market is now about 10-12% cheaper than average. So, it's not really in territory where valuations are blinking red. If anything, valuations are, in a fairly reasonable comfort zone. But yes, it's going to be tricky territory because potentially we could be looking at yet another year, which is FY14, where earnings growth may fail to get beyond double-digit growth levels. So, that is certainly a little bit of a risk as far as market valuations are concerned. But I would still say that we're not really in expensive territory, we're in reasonable territory, and therefore to that extent valuations itself are slightly supportive of this market. And even if I stop looking at averages and look at it from the perspective of individual stocks that we can look at or look to buy in our portfolio, then there are several stocks which are now trading significantly cheaper than average. The risk in buying these stocks or these companies is really the fact that we really don't know how close we are to a turnaround. So we could be 6 months away from an economic turnaround, we could be 1 year away, we could be 2 years away for all that we know. And that really is the risk in buying these companies at this point of time. But I think as portfolio managers, to my mind, the biggest risk in markets is not flows, it's not economic data, it's always valuation. And therefore from a valuation standpoint, I don't think I can categorize this market as being at risk at this point of time. There are several other risks, but not from a valuation standpoint.
Do valuations really matter though in this kind of an economic and earnings environment, as also this much uncertainty, Vetri? I mean, would it be as easy to construct a scenario where valuations go back to historical lows, i.e. move to the 10 times kind of band?
It's a probability outcome, Mithali, and therefore what you have to see is what are the kind of odds in terms of the returns you have historically earned in the past at current valuations if you were having a fairly long-term view of 3 to 5 years. And I think the odds have now turned fairly favorable. We can discuss the data, and there's a lot of data available out there, but just to give you in a nutshell, the odds are favorable if you have a 3 to 5 year outlook. They are not yet favorable if you have a 6 month to 12 month outlook based on past historical trends. I think if you are an investor with a medium-term perspective, it's not a bad idea to start looking at the market at this point of time and, be clear. The window of opportunity is wide. The window of opportunity may be deeper than what we are currently presuming. But if you are here for a 3 to 5 year outlook, there's no reason to argue against starting to make equity allocations at this point of time because, as I said, the valuations are, reasonable.
What is your best case, Vetri, of how long this cycle takes to turn around? Because we've been hearing about this is the trough, and next quarter earnings will start to pick up for about 6 months now, and it's not happened. Do you think we are going to get a meaningful earnings bounce in the next quarter or two, or do you think we are in it for the long haul? It's not that close around the corner.
Yeah, I don't think we've ever operated on the basis that we are near a trough, because none of the data we've been seeing for a long time now have been telling us that we are anywhere near a trough. So I don't think we've at least been espousing that point of view. But it's really hard to say again as to whether it's 6 months away, it's 12 months away. I think certainly the government has shown a little bit of momentum in terms of decision making, but it takes time for these things to translate into action on the ground. So unfortunately, the only answer I can give you is that you've got to be patient because I don't think we are in this game of predicting whether the turn is 3 months away or 6 months away. It's just not clear to us at this point of time. Unfortunately, we've boxed ourselves into a situation which is a little bit like going into the last over of a T20 match and you suddenly have 24 runs to score or 30 runs to score in the last over. Can it be done? Yes, it can be done. But what's the probability of getting it done? Unfortunately, not all that good. So, you had 4 years in which momentum has been continuously decelerating, and you're now trying to turn it around very dramatically in literally the last over. It's not going to be easy. And I think having said that, the bigger point that I'd like to make, and this is something we've been talking about for the last 4-5 months, is that finally what we are starting to see is that the effect of the economy is starting to show up on entrepreneurs in the sense that corporate India is trying to deleverage. We've seen companies sell their so-called family jewels to save the business, to save their own personal finances in the last 6 months. This was completely unthinkable maybe 2 or 3 years ago that these entrepreneurs would be willing to take such decisions, but it has happened. And this is the natural process through which we need to go through, in which corporate India will need to deleverage. Poor assets will have to get sold, some good assets will have to be sold to somebody else to repair the existing assets. And to that extent, in fact, when we talk about the investment cycle, one of the challenges that the investment cycle faces is how many other good policies Government of India comes up with at this point of time. Corporate India is not in a position to be an aggressive investor because they've already got projects which are stalled all over the place. The bank banks are not in a position to lend aggressively because they are facing the pain from non-performing assets, and their credit deposit ratios are stuck at 77-78%, which are like 10-year highs. So there is a little bit of a natural problem here in terms of trying to turn around the ship. Even if the government were to deliver on policy, I don't think corporate India is really in a position to go out and invest aggressively. They are right now in deleveraging mode. So we've just got to be patient and wait for this movie to play out. I think the good news is that because you've entered the deleveraging phase, you're closer to the second half of this getting over than you were maybe 6 months ago.
Stay on, Vetri. We'll come back and carry on with this discussion. For now, the market's okay, 20 odd points higher on the Nifty, a third of a percentage point higher on the mid-cap index. We'll come back.
In fact, for the last 4 to 5 trading sessions, stock has been showing you an uptick. With that, it's back to you.
At small caps, mid caps have virtually surrendered most of their gains this morning, and the mid cap index is up just about 10 points. So very lackluster morning despite expectations of a smart pullback. But you have a good pulse on the retail mood running a mutual fund. Do you think this kind of disinterest might continue for a long time now, where people figure out that equity as an asset class might actually continue to generate subpar returns, risk adjusted, for even the next 1 or 2 years?
If you look at the issue of retail behavior, to be fair to retail, I think they've got the last 3-4 years bang on. Going into gold, going into property as opposed to equity has worked out very well for them. So, I don't want to sound like I'm beating down on the retail investor, but having said that, there is no doubt, as with all money allocation flows, there is always a degree of momentum which is required in the underlying asset class for investors to start to increase their allocations to that asset class, and that's always been the case with the, and even if you go back to 2003, I recollect going to investors and talking to them about equity markets, which were in fact in valuation terms maybe about 15-20% cheaper than where we are today in valuation terms, right? And at that point of time, the answer was that, look, bond funds have given me 14-15% CAGR over the last 3 years. Why should I put my money in equity, which has hardly delivered anything over a 3-year period? So, I think to expect that domestic flows and particularly retail flows will turn around very dramatically in response to valuations, not really the argument that I would make at this point of time. I think there is a case that over time Indians will have to reallocate some of that money that's gone into property and gold into equities, but maybe not just yet. I think you'll have to see a little bit of underlying momentum come back into the market before that can really start to happen.
Responses vary on how people choose to define the setup, Vetri, but would you say what you've seen over the last couple of months looks like the market's gotten into a bear patch for itself?
Bull or bear, we've been in a tough market for the last 2-3 years, Mithali, and we've just been sort of range trading in a 20-30% range. I've said this many times in the past, a lot of what has happened in the last 3-4 years reminds me of a very similar environment that we faced way back in about 94 to 1998, and then it was punctuated by the whole tech boom. But those 3-4 years were very similar as well. We had a range trading market. The ranges were actually much larger than what they are today. The market used to do plus 30-40% every 6 months and then lose it promptly all over again. This time the range is more like plus 15, plus 20%. We've gone through various issues. There was the Asian crisis in 97-98. This time it's been the Eurozone crisis. We had the problem of a weak currency at that point of time. We had pressures on the fisc at that point of time. And we had companies which were battling to get their balance sheets back into shape again. So a lot of that is actually similar at this point of time, and I think we just need to be patient and wait for the entire cycle to play out and realize that it's not just about calling global liquidity right, it's not just about government getting its policies right, but everything needs to come together again. One of the challenges that we face in that sense is that, we've got some indicators which are blowing completely cold. So when you look at data like automobile sales, two-wheeler sales, cement sales, I've never seen them as bad as I've seen in the last few months, in the last 15, 20 years of watching data. And at the same time, you've got some indicators which are blinking red. So you look at inflation, you look at the current account deficit, you look at the credit deposit ratio, extremely elevated. So, on average we seem to be okay, but half our indicators are blinking cold and the other half are blinking red hot. And I think we just need to give the economy some time to sort of reconcile these, get them back into sync at some level, and then we can hope for something more sustainable to build out. So really there's no option but to be patient at this point of time.
That's on a long time, Vetri. That's the only problem. You guys run a PSU fund of some kind, if I recollect. What have you made of the kind of experience people have had with PSUs, these divestment opportunities? And more than that, what happens to some of these stocks post that divestment episode taking place?
It's been a bit of a disappointment because I think, government policy, unfortunately, till very recently has actually been sort of perversely hurting PSUs rather than benefiting them, and that's not what you would expect a government to do if it had a lot of stock to sell to investors. So unfortunately, that's not worked out as well. I think as a basket, the public sector companies in terms of valuations are, quite reasonable. They tend to be, in most cases, net cash on their balance sheet, so potentially they could use a lot of that cash to invest aggressively and to grow their business in what is a tough and challenging environment to their advantage. But I think some of that has not played out as well as we would have hoped for, as anticipated. And I think unfortunately PSU disinvestment has just tended to be a tap in which the government continuously comes out with issues in the same companies with too brief an interval between them trying to raise money. So I think it needs perhaps a little bit more thought on how we could go through this whole thing of PSU disinvestments in a more sort of market-friendly fashion, and also have policies which actually are sort of supportive of PSUs rather than using them as milk cows to achieve some of your other objectives in terms of the fiscal deficit. So I think in that sense, one of the first good steps that we saw was the attempt to remove the burden of fuel subsidies on these PSUs and transparently take it into the government balance sheet. Now, for example, if they continue to follow through with that, and they've certainly been encouraging to us that they've followed through with it over the last 3-4 months, then I think the case for re-evaluation of the prospects of those companies is quite significant. So they've started to understand the message and do things, but we need to see a little bit more of that for the PSU disinvestment story to play out.
Just to touch upon your point on valuations, Vetri, do you fear that some of the more expensive pockets of the market, which have held the overall average for the Sensex up, they might actually need to adjust on the way down? Prime of them could be the consumer space?
Potentially then, but the way I look at it, I don't want to get caught up in the issue of whether they will necessarily correct at this point of time as part of any market fall if the market falls, but look at it from the perspective of even if these companies were to grow, given where starting valuations are today, can you really realistically expect to make money in some of these companies over a 2 to 3 year time frame? And if the answer to that is no, then I think in some senses you have to now rebalance your portfolio away from those areas and look for more value in cyclically depressed areas. So it's a fine balance at this point of time in terms of how you play out the strategy, because you want to keep your performance overall looking good at this point of time, but you've got to be sensitive to valuations. You've got to look at valuations in the context of, if things go right, then over 2 to 3 years, where am I more likely to make money, and be willing to absorb a little bit of pain, because the market could continue to punish some of those cyclical areas in the short term. So it's a balancing act, but we've been taking the call for a while that the defensive and non-cyclical areas are trading at very rich valuations, and therefore making money out of these areas over the next 2 to 3 years is a challenge, because the PE multiples are already so high. So we need to rebalance away from them. If that causes our portfolios to take on more cyclical areas where valuations are cheap, potentially it could hurt us relative to market in the short term, but over the medium term, that's the right thing to do, and therefore we're more focused on that medium term approach than what's necessarily the best way in 3 months or 6 months.
Thanks, Vetri, for joining in. Good to hear your thoughts. That's Religare Mutual Fund. Meanwhile, the mid-cap index is drifting into the red. The breadth has turned negative. We